All right, this is a review video, extra practice for monetary policy. You should have the sheet with extra practice for monetary policy standard with you so that you can fill out those answers so that I know that you're ready to retest. And I'm going to go pretty quickly, so feel free to pause the video if you need to write something down and ask me any questions you might have after the video. So let's start with inflation. Inflation is a general rise in prices. And that happens when the value of money drops. Usually that happens because there's too much money in the economy. So to slow down inflation, contractionary monetary policy is needed because it takes money out of the economy to make it worth more and reduce prices. If you think about it, if there's less money in the economy, each of those dollars is going to be worth more, and so prices will come down because each dollar is worth more. The CPI is the Consumer Price Index. It's a measure of inflation. What the government does is they measure the average prices of important goods and services each year. So the same goods and services one year, and then they measure the price of all those goods and services the next year, and the next year to compare how prices change. And that's how they measure the price level in the economy and inflation. The money supply just means all the money we spend and save. And it's more than just bills and coins because we have what's called a fractional banking system. Fractional banking system is when banks take deposits and then loan most of that money out. So when you put money in a bank, your money is not actually in the bank. What the bank does is it takes the money, it tells you that it's there, but then it loans the money to someone else and they pay it back slowly. So if everyone tried to take their money out of the bank at once, it would not work. And what it does is this multiplies the money in the money supply because I think I have money in the bank, and then the bank gives out a loan and that person puts the money in the bank and they think they have money in the bank, and then the bank does the same thing. More money and more loans equals increased aggregate demand because the more loans get made, the more money people have and the more money they spend, and that creates jobs and more spending. So here's how a fractional reserve banking system works. We start with someone depositing $1,000. The bank reserves 10%, they keep $100 in the bank, and they loan out $900 to this person. And that person puts their money in the bank, their loan money in the bank, and then that bank saves 10%, the $90, and loans out the other $810, and then that person puts the money in the bank. And that bank keeps some of it in the bank and then loans out the rest of it, and so on and so on. So the same $1,000 now shows up in this person's account as $1,000, and this person's account as $900, and this person's account as $810. It gets counted over and over and over. And this multiplies the money in the economy. A lot like the multiplier effect that we talked about in fiscal policy. Works the same way. So the crisis that the economy had to deal with in the 1970s, and the one that monetarism, or the economic theory created by Milton Friedman, the crisis was stagflation, when there is high inflation and high unemployment. And what happened was, we had Keynesian economics to tell us that, well, if the economy is bad, if there's high unemployment, just spend more money. But that doesn't work if there's high inflation, because if you spend more money, then prices keep going up and inflation gets worse. So monetary policy needs to be used to bring prices down. Milton Friedman was the primary economist who was associated with monetarism. And monetarism is the idea that we should use the money supply to control inflation and to to improve the economy or to slow down inflation. It is better than fiscal policy because the government's not trying to figure out what to spend money on. All we do is we put more money out into the economy and loan more money out, and individual people pursuing their self-interest will make the decisions the government wouldn't probably get right. And monetary policy is pretty much the only way to control inflation. When prices are rising, we just want to decrease the amount of money around, and that'll mean that people will be able to spend a little less and prices will come down. It's the easiest way to control inflation. So monetary policy in general is when a central bank changes the money supply to affect aggregate demand. An expansionary monetary policy is when the central bank increases money supply, increases the amount of money in the economy. And contractionary is the opposite, when it decreases the money supply or decreases the amount of money in the economy. The Federal Reserve is the central bank of the United States, and its job is to keep inflation and unemployment low. and it has the power to create and disappear money in order to do that. It was created by the government in 1913, but it's not directly controlled by the government. It actually operates independently, but it is overseen by the government. And what tools does the Federal Reserve have to control the money supply? Well, there are three main tools. Open market operations is the most common tool that's used. And open market operations, they want to try to control the federal funds rate. And that's the rate that banks charge one another for short-term loans. And most loans in the country are tied to the federal funds rate. So if the Federal Reserve can change the federal funds rate, then it can change the interest rate for all kinds of loans in the entire country. Student loans, car loans, mortgage loans. And that would either speed up spending or slow down spending in the economy. The discount rate is another way that the Fed can control the money supply. The discount rate is the percent, the interest rate that the Federal Reserve charges banks when banks borrow directly from the Federal Reserve. And the reserve requirements is how much money the banks in the country need to keep in the bank and are not allowed to lend out. Because if they, if they have to keep a lot of money in the bank and they can't lend it out, the money supply is going to shrink. But if they can keep very little money in the bank and they can lend most of it out, then the money supply will grow. So open market operations, how do they work? The goal is that they want to change the interest rate that banks loan each other money, which changes all interest rates. And so to increase the money supply, the Federal Reserve buys bonds to get more money into the economy. Because when the Federal Reserve buys a bond from a bank or the public, they pay money for it, and that money is brand new. They just created it out of nothing. And that increases the money supply in the economy. To decrease the money supply, they do the opposite. They sell bonds. Because if they sell a bond to the public or banks pay money for it and gets money out of the economy. So here's a visual way to look at it. The Fed buys or sells government bonds to put more or less money in the economy. And this changes the federal funds interest rate. So if they buy bonds, then they increase the money in the economy and they increase spending. And if they sell bonds, they take money out of the economy and they decrease the amount of spending in the economy. The discount rate is when the Fed changes the interest rate it charges banks for loans directly from the Federal Reserve. So banks can borrow more or less money from the Fed, and that changes the amount of money that they're able to loan out to the public. Reserve requirement is when the Fed changes the percent of deposits banks need to keep in their vaults. So banks can either lend more or less of their deposits into the economy, which changes the amount of money loaned out. And again, the more money loaned out, the more money that gets spent, and the increase in aggregate demand, which helps create jobs. Monetary policy, again, is when the central bank changes the money supply to affect aggregate demand. Expansionary is when they increase money supply and decrease interest rates, because if interest rates are lower, more money gets lent out. Contractionary is when they decrease money supply and increase interest rates, because if interest rates are higher, then they don't lend out as much money into the economy. So expansionary monetary policy, all the tools that could do expansionary is when they buy securities to send money into the economy, and this lowers interest rates because banks want to loan out that extra money they have. They could lower the discount rate, which would make it easier for banks to borrow money from the Federal Reserve and then lend it out to the public. Or they could lower reserve requirements, because then banks could loan out more of their money. All of this tries to get more money into households and businesses to increase aggregate demand. And we use expansionary monetary policy when there's low inflation and high unemployment. And that's because we want to create more spending and more jobs, but the more money we put out there, the higher prices get. And so if there's low inflation, that's okay. But if there's high inflation, we don't want to do that. So it's needed when the economy is shrinking or growing slowly. It helps increase aggregate demand, but it can increase inflation because the more money that's in the economy, the less each dollar is worth. That's expansionary monetary policy. Contractionary monetary policy is when the Fed sells securities to take money out of the economy. This increases interest rates because banks have less money to lend out, so they can charge higher interest rates. The Fed can also increase the discount rate, which makes it so that banks don't borrow as much money from the Federal Reserve and then don't lend out as much money. Or they can increase reserve requirements for banks so that the banks have to keep more money in the bank. They're not allowed to lend it out. All of this tries to get money out of the economy to slow down spending in the economy. And this contractionary monetary policy is used when there's high inflation, but it'll slow down the economy. So it helps control inflation, but it'll also slow down the economy, and usually the unemployment rate goes up after this. So it's needed when the inflation is high and prices are rising, and it helps shift aggregate demand to the left, which lowers the equilibrium price, so it lowers prices. But when aggregate demand shifts to the left, businesses don't hire as many people to make things, so unemployment can rise. So it slows the economy down, but at least inflation gets lowered. So when we use this, if the economy is slow or shrinking and there's high unemployment, but inflation is low, then expansionary monetary policy is needed. We want to speed up the economy. Even if prices rise, that's okay because inflation is low. But if inflation is high, then contractionary fiscal policy is needed. Sorry, that should say monetary policy. Contractionary monetary policy is needed to decrease prices. It takes money out of the economy and it decreases prices. So again, expansionary fiscal, this is a total review. Expansionary fiscal policy creates jobs and can create inflation, and the government creates debt because they have to borrow. Expansionary monetary policy creates jobs, but it also creates inflation. Prices start rising. Contractionary fiscal policy slows down the economy, but at least they can pay off the government debt. And contractionary monetary policy slows down inflation, but it also slows down the economy. This is a chart to look at when we would use each type of policy. If unemployment is low and inflation is low, we could use fiscal contraction. The economy is good, so we'll use fiscal contraction to slow the economy down a little bit, but we can pay off our national debt. But if the economy is good and inflation is high, we'll use contractionary policies to take money out of the economy to slow down inflation while we continue to pay off the debt. If there's high unemployment and low inflation, then we want expansionary policies to help speed up the economy, even though prices are going to rise because of it. And then if there's high inflation, even if there's high unemployment, if there's high inflation, this is stagflation, we probably want to use monetary contraction to slow down the price rises and take money out of the economy. And this is actually what they did in the 1970s with stagflation. Monetary policy, they contracted the money supply in the 1970s and it slowed down inflation. If you have any questions about this topic, please come find me and complete the worksheet to show me that you're ready to retest.